Thank you everybody for making the trip tonight. I guess it's best to just start off with a bit of background. For those who don't know us, I'll kick it off. My name is Chris Bendiksen. I am the head of research at Coinshares. We're Europe's largest digital asset manager. We issue exchange-traded products on crypto assets. We have about 750 million under management, most of it in our Bitcoin product, most of the remaining in our Ether product, and then we have a Litecoin and an XRP product as well. Some of the research that I do revolves around mining. Paul gave a flaming intro to mining, but I think it's actually important to emphasize how important mining is for the functioning of Bitcoin. It actually doesn't work at all without it. It's the main new innovation that actually triggered peer-to-peer cash and peer-to-peer final settlement currencies to actually become a real thing. This was something that's been attempted for decades before, and no one really pulled it off because it wasn't actually achievable to get distributed consensus without mining. So when Satoshi put this all together, leaning on Adam Back's innovations on reusable proof of work, and put it all together, that's when things really happen. So I think mining is it's definitely underappreciated as a very serious part of this business that needs to be scrutinized more deeply, looked into more carefully by analysts, by people who are interested in the space. It's a multi-billion-dollar industry annually, draws around 7 gigawatts right now of electricity. It's a very big industry, right? So that's why I want to focus on it as part of the research output that we do at Coinshares. This is important for our biggest underlying asset. It is important for the health of the network, and knowing what's going on in the industry means that you have some indication on whether or not Bitcoin is doing well, essentially. So with that, I'll leave it to you to introduce yourself.
Yeah, cool introduction. Hi everybody, I'm Pavel Moravec. I'm co-CEO of Slush and Braiins, which is a company behind Slush and other products in Bitcoin mining space. We do operate and develop the first ever mining pool in the world, namely the Slush Pool. It's been almost 10 years. It's going to be 10 years this year, and my personal participation is from early 2013, and since then I'm full-time Bitcoin mining person. So I remember a lot of things what happened in the last years, and it's a ride. Things are changing year by year, and it is really interesting to see how the whole space is progressing towards more professionalized, more public, much more optimized industry. It's really interesting to see. Yeah. And my technical background is I'm by nature a software developer. Wow. Okay. Software developer. Yeah, so computer geek basically.
So let's do a quick gauging of how familiar people here are with mining. How many people would say that they're very familiar with how mining works and how the industry is structured? Danny, obviously, OG. So around like a quarter of people are very familiar with how it works. How many of you would be able to name me the hashing algorithm that Bitcoin mining uses? All right, okay. So how about we take things like way back in history. So it's 2009, Bitcoin kicks off. It's a whole year actually before the difficulty increases. It's actually hard to say whether or not anyone except maybe Satoshi and Hal Finney and like 2 or 3 other people were mining it all back then. And it's not actually very much longer after that Slush Pool came into existence, and during that time there was a big debate, first of all, of should should we pool mining in the first place? That was a big debate. And if we do, how are we going to do it? So why don't you tell us a little bit about the development of mining shares, what mining shares are, and how they work, and also a little bit about what pools do. Like what is the essential, what is the point of a pool? Why do we even have pools? Why don't everybody just mine for themselves and that's the end of it?
Yeah, there is easy answer and very complicated answer, obviously. But it's all started with Marek Palatinus. He created the first pool. He mined himself, and it was really difficult to find a new block. Once more and more people started to play the game of mining, the chance that anybody could find a block was decreasing. Like for one specific period of time, you had lower and lower probability of finding a block. So your investment into mining was more randomized. Like the expected value you can get from mining was the same. Like it was given by how powerful your machines were at the time, and it's still correct in today's world. But the more people join this mining, your chance of getting the block was lowering because there is a limited number of blocks generated in a certain period of time. So the pool mining solves this problem by aggregating all, like a lot of users' hash rate, then behaves like one single miner, finds a block and split the reward. So it decreases the variance in income for the miners, which is obviously a good thing from economical perspective, because then you can make your projection of your income, you can make an investment, then you are being paid by the hash power you are providing to the network, and not necessarily only paid by a luck you have as a single miner. So you as a group of miners joining into a pool are mining as a single person. That's the core principle, and it is essentially you have to do it nowadays. If you're not a company investing $100 million, then you have to use your pool or some kind of pool. Otherwise, your expected or the variance in income is so large that you can be out of the business earlier than you get your expected coins, which is something people don't appreciate or understand a lot. It always strikes me that this is so core thing for the whole Bitcoin world, and at the same time it's complete niche. I mean, people should be interested in it. I'm 100% agreeing with my co-speaker. I don't know why people are not paying attention, because they really should. It can blow up all Bitcoin. If there is major problem with mining, whoever wants to be super rich by investing in Bitcoin can forget it, because it's gonna crash. It's so important.
Yeah, I completely agree with that. And I mean, if you think about the lack of interest that there is in this space, I mean, this is a pretty full room, at least now, indicating that there's some interest in this. But if you look at the amount of Bitcoin conferences there are on a yearly basis versus how many of them actually focus on mining, or how many of them even mention mining at all, it's really crazy to watch, especially when you think about the fact that the mining industry is one of the biggest revenue generating parts of this whole economy. It's a multi-billion-dollar industry year on year. The most valuable companies in Bitcoin are all producers of mining hardware, literal unicorns with billion-dollar valuations, at least up until,
Go public.
Yeah. But so, reducing the variance on mining is obviously extremely important because miners have ongoing cash flow liabilities that they need to cover. However, when you do actually pool everybody's hash power into one bigger pool, you run into potential issues with centralization, and that's something that sort of crept up on us. And in case people don't know, there are protocols for how miners actually interact with their pool and how they share their hash power, how they prove the amount of hash power they contribute to the network, and how they're paid out as a reward for that. And the protocol that is used for this is called Stratum, and that protocol kind of just came out of nowhere, if you will. It just happened a bunch of years ago, and it works, but it causes a bunch of issues too. And maybe you can describe some of the issues that come out of this protocol.
Yeah, gladly. It was not out of nothing. It was based on some electron work, I think. The protocol was not meant as a mining protocol. It was, in the sense, it was a coincidence. And even though it was created with the best intentions in that time, it was a necessity to bring some protocol which would allow ASIC miners to work, because until that point in time, everything worked on HTTP, long polling, kind of craziness. You can imagine hundreds of thousands of machines connected through HTTP channel, waiting for a work to work on. It was completely ridiculous. So at that point, Stratum protocol was clear improvement, which allowed pool miners to get work on a regular basis, and it's somewhat, I don't want to get into very details, but yeah, it allowed basically large-scale ASIC mining, but it's a random protocol basically. The whole point of, or one of the clearest point about pool mining is it shifts the whole industry from one CPU, one vote, as was mentioned here before, towards you are my slaves, and I, as a pool operator, I can do anything with the hashing power you are connecting to me. It is almost that bad. The reason is, if you are a pool operator, you can choose what kind of jobs the miners are working on. So you behave as the single miner. You're renting the clear hashing power, but you're stealing the voting power of the miners, if we can call it like this way. And this is unsolvable in the current protocol, and there is a movement which we try to push as hard as possible for changing the protocol to a new one. We call it Stratum V2, which would give back this voting power to the actual physical owners of the hashing power. So we need, for economical reasons, we need pool mining, because the variance smoothing is a critical thing from like business perspective. But what we don't need to have in this scheme is transferring the voting power from the physical operators and owners of the hardware towards pool operators. So we, as a pool operator, we don't want to have this power. I think we all as an industry would be better off if the voting power would be really distributed in hands of the actual physical owners of the hardware, and we can still provide the service, and we can be paid for it, and it's perfectly fine. But we as a community would be better off.
Yeah, and I'll give some context on that too. So who here remembers the Segwit 2X debacle? So not that many. And this is a perfect example of why this actually matters quite deeply. So one of the mechanisms by which new Bitcoin improvement proposals, or BIPs, are actually implemented into the protocol is through a mechanism whereby miners will signal their readiness to upgrade, if you will, through adding a bit of information to the block header. Yeah. So
it's not going to be this way anymore.
No,
after the debacle.
We'll get to that. We'll get to that. So, what this led to in this particular context was that there was a group of people that wanted to implement a certain rule change, a pretty serious rule change actually. It would be adding new consensus rules, which is referred to as a hard fork. And they had a large mining majority behind them, or at least a large signaled mining majority behind them, because they had a bunch of pools essentially voting in favor of this proposal on behalf of all the people who belonged to the pool. So this is what Pavel is talking about when he says that the pool has a disproportionate share of the vote for these proposals because they're voting on behalf of everyone who is pointing hash rate to their pool. And this is problematic for multiple reasons, because it doesn't actually signal what the community wants. So what happened back then was that you had 90% plus of hash rate, I think, signaling their desire to implement an increased block size, which would, require a hard fork. And at the same time, for people that were in the community, there was a bit of a disconnect, because most of the users that were present at the time were actually not in favor of this. So you had this disproportionate signaling effect from pools versus what the users actually wanted. So this actually came down to a pretty big conflict in the end that was solved in a way that I haven't seen any other proposal solved. It essentially turned into a bit of a Mexican standoff, where you had, in the end, a user-activated soft fork where node operators, like full node operators, threatened to orphan blocks from these miners if they actually went ahead and triggered this proposal. So what Pavel is saying is that this is not even a power that pools necessarily want, and it is an unintended consequence of the initial structure of the Stratum protocol, and it is something that they're actually actively working on fixing now, and it would radically change the level of decentralization, if you will, in mining. So right now, it is the pool that decides the contents of the block. It decides which transactions to include, and it essentially makes all of the decisions on behalf of the miners. Under Stratum v2, this would change, and maybe you can tell us a little bit about what that would look like and what the consequences would be for, transfer of power from pools to individual miners.
Yeah, one more comment. I would not blame the original author of Stratum v1, because
Absolutely not.
we tried to figure out the voting transfer back to miners for several months of very deep thinking, and after having all the experience from the earlier times, and with one of the smartest people working on Bitcoin Core software itself, before we found a way how to make it efficient enough to actually deploy it in the current mining infrastructure. Yeah.
So can I just ask a question? I'm not a mining expert at all. When you talk about the Mexican standoff, where is a debate happening and how is it resolved? Who's talking to whom? How is it happening? What's the medium of communication? Twitter.
Yeah, right. Well, literally a lot of it went down on Reddit, on Bitcoin Talk, on Twitter, through social media. I mean, what you're looking at is an open source decentralized project, which is not organized by anyone in particular. Anyone can be a part of it, and anyone's voice can be heard if everybody else figures that they're worth listening to.
But okay, so in terms of like a large miner versus a small miner, whose voice is the loudest or the most has most influence? What happens?
So, again, are you talking about, yeah.
You as a miner needs to behave correctly. Otherwise, if there is enough users using the coin would think that you are not behaving correctly, they can easily not accept your mined coins. And therefore, you spend a lot of electricity building something what is worthless. So this threat was at the end the reason why the majority of miners like followed the crowd, and they just behaved as the users wanted. But it was not a hard thing. They just felt that there is enough people out there who would not accept the coins.
Is this a stable way of managing a situation?
Well, that is a great question.
Yeah, you can do some research on this topic. It would be useful. But I think the whole story gave us something for the future. I think miners would not try to do against the wall again. At the same time, developers will not activate the crucial development efforts this way again. It would be always like a deadline and planned upfront so that everybody can upgrade, and not decision by miners, because it creates this kind of gaming opportunity for miners to try it, do it different way. So we learned a lot from this particular event. But I think it's better for everybody that it happened, and at the end it was a nice ending. So
Thanks for tolerating my ignorance. Thank you.
No, and look, and correct me if I'm wrong here, but I don't think the intention originally of using miner signaling was to sort of put power in the hands of miners. It's more a security measure. Like, you want to make sure that by the time a change in the code is implemented, everyone has actually had enough time to implement the change so that everyone is on the same rule set going forward. It wasn't, at least I don't believe it was intended as like giving voting power in that sense, or veto power or anything like that. You know, this situation happened, and like Pavel says, like, I think a lot of lessons were learned, and you know, this whole space, if you think about it, is we're all making it up as we go, you know?
You're right. I'm down the rabbit hole, but I'm totally not a computer nerd. I don't really, understand it all. So
Yeah.
it's hard for me to process.
No, absolutely, and please ask the question. I don't feel like
right now all the miners are completely professionalized teams. They keep updating the software all the time. Everybody follows what's the latest improvements. So there is no risk of miners not following the protocol changes. And so we don't have to use this mechanism anymore. But in the case where one CPU, one vote, it was a very useful concept to have. Like once 80% of, yeah.
From your opinion, what path do you see developers trying to take to activate Taproot and Snore in the next?
I think it's going to be flag date, and it was, I'm not sure if decided, but I think majority of people is taking it as a fact. Because again, there's, from users' perspective, it's not a big deal. From miners' perspective, everybody knows about that, and there's consensus about being it an improvement. Segwit 2x, or these things, it was just a heated discussion because of politics, and there is no politics about Taproot at all, which makes things much easier.
Talk a bit about the difference between Stratum version 2 and Beta Hash. Are they separate things?
Yeah, it is quite common. The difference between Beta Hash and Stratum v2, it's a quite common question. Thanks for bringing it up. It started as two completely independent things. Matt Corallo felt that there is a space for better mining protocol, and he is a protocol developer and Bitcoin core developer himself for a lot of years. And there is obviously a space for improvement, so he worked on that. There were some private parties behind mining who would like to push the users' vote forward, because from ideological perspective it makes sense. So we were even approached as a pool if we would implement better hash to help this push to happen. But at the same time, we already had an internal proposal for making improvement to the protocol, because we as a company do, on one side, the pool service, and at the same time we write firmware for the miners. So we know the protocol from both sides, and we have years and years of experience, so we know all the terrible features of the protocol ourselves, and it's from our garage. So we feel as a responsible company for doing something with this. So we created a different proposal, and then we faced the fact that Better Hash came with an idea to get back the voting power to users. We didn't think about it before. We tried to solve a lot of our other technical issues with the protocol. It's a whole list of things what you can make better. But then we saw the Better Hash, and it was obvious that it's a genius idea. And we did some review for Matt. He asked us about our opinion, and unfortunately we were unable to implement it in production because there were some security risk on the pool side, which would be basically killing feature for us in the wrong sense. But the idea was awesome. So we thought that it would be nice to use this idea and bring it to Stratum v2 and make it so that pool can easily implement it without introducing additional risk and without introducing some, let's say, resource requirements which would be unbearable. And then we spent a few months about thinking how to make it happen. And with Matt Corella as a co-author, we spent some serious time together to finalize all the small pieces of the protocol. We think we found a solution, and we try to push it. The idea is to have a public open source implementation this year, and yeah, let's hope for adoption.
With one thing that I liked about the Better Hash proposal was the fact that the miners could select the transactions to include. Is that the same in Stratum v2, where that role is back to the actual
the core idea is exactly that a miner can run full node. He can make a block template, let's say. So it's about choosing the transactions to the block and choosing the version bits which were used for signaling the readiness for an improvement. And the miner could assemble the block and then mine on the block. So if he is successful, then this block would be created and propagated to the network. The problem with Better Hash was it was basically super easy to attack on the pool by not giving the block to the pool or claiming work which is not correct, because pool didn't have a chance to double check that the work would actually lead to a proper block. And it was like, yeah, we could not accept that. So we needed to find a way how to not spend a tremendous amount of money on resources for double checking the block sent by miners, and at the same time allow them to choose their transaction on their side. And it's hopefully solved.
Let me just give a little bit of context on that. Why is it important that an individual miner gets to choose their own transactions, right? Because it's implicit in your question. So if you think about it, the actual censorship resistance in Bitcoin stems from the fact that if a miner refuses to add certain transactions, they are economically penalized by not being able to collect the transaction fees from that transaction. So part of the reason why it's important to give that power back to individual miners is that if you leave that power to your pool, then the pool could arguably censor transactions that you don't want to censor, that you want to put in. So you don't actually get to have a say in which transactions actually make it into the block. The pool decides that for you. And that is one of the, like you said, unintended consequences of the Stratum v1 protocol. So what's happening now with the new protocol that they're designing is that individual miners, no matter how big or how small, can pick their own block, choose their own transactions that go in there, and then work on the proof of work. So previously, a pool would assemble a block, then send a request for work to the individual miners, who are then literally just using that block template to find their proof of work. Now they get to choose their own block template to find a proof of work. So you are taking the power of picking transactions and putting it back in the hands of individual miners, if that makes sense.
I've got a kind of non-technical, quite theoretical question, if you're up for trying to answer it. I just wondered, just trying to get my head around computing power and ASICs aside, how many modern-day smartphones would be equivalent to a modern ASICs miner, and how many ASICs miners are there currently mining?
I think you're better to.
Sure. So I think
High level math.
yeah. Arrest me here if I'm wrong, but I think one hash is something like 18,000 floating point operations, give or take. So you can try and figure out like how many floating point operations per second your smartphone could do. And a modern miner.
No floating point operations.
Well, equivalent.
Yeah, they're only integer operations.
You can see where I'm going, but I just want to see if it's possible.
So a modern miner does what, like 50-ish quintillion hashes per second, which would be roughly equivalent to 50 quintillion times 18,000 floating point operations. I did some back of the envelope math on this like back in the day, but I don't know. The answer is a lot.
So
a lot.
The precise answer is a lot. Like
more than all the smartphones in the world?
no way, not even close, not even close.
You're talking about one single unit.
I'm thinking about one ASICs miner modern versus like an iPhone 11 Pro, just trying to figure it out. Like,
It's completely different order of magnitude of operation, and there are millions of machines like this in the world.
I guess the other question is there any way back from ASICs?
No. And that's the point. Yeah, that's the whole point. Bitcoin mining has interesting, maybe intended, maybe not intended feature, which is the chosen hash function is super easy. So it is quite easy to make it in hardware, and there is not a lot of things what you can do differently. So the difference between efficiency of various hardware from different vendors is like 20% maybe, and it's getting slimmer, which is awesome because then you can very efficiently change electricity into the hashing power. And it doesn't create a lot of differences between miners, because what you want is the highest level of distribution of the hashing power as you can achieve. So the easy hashing function can make things easier because there is not, let's say, algorithmical twist you can think of and being much more efficient than other person. So it was a clever or unintended geniusness.
Is it fair to say that it's not really the hardware that's a centralizing factor, it's the cost of electricity?
Well, yeah.
But if you had it on smartphones, you still got to pay to power the smartphones, and that's
Sure.
what's going to...
Well, let's also keep in mind that there's a hard limit on how much mining can centralize. It cannot centralize more than global power production.
Just on that, so I don't know if you're familiar with ESG investing as a theme, it's picking up pace.
Yep.
Environmental and sociological impact.
Mm-hmm.
You know, at what point does this become so resource intensive, energy intensive, that it picks up too much negative? But what happens? Is there some pushback somehow?
There's been pushback for a while.
Yeah, but the whole ESG movement is kind of now picking up a real, the Greta Thunberg movement and everything around that.
Yeah.
The ESG is a real sort of thematic play, and I just wondered, as this becomes more energy intensive, does it come under pressure more and more from regulation or control?
Yeah, but potentially, for sure. I mean, it's something to look into. It's an energy-intensive industry, but it comes back to the question of like who makes the decisions on what we direct resources to in society. Is it the individuals who choose that? I find Bitcoin to be a very valuable product. It's something that I want to use, and I pay for mining through dilution, and I'm okay with that. And if I want to pay for electricity to have Bitcoin running, that's up to me. And if I want to pay for electricity to run Christmas lights or computer games or watch the Kardashians, that's up to me. And
Bitcoin mining.
yeah, no, exactly. And I choose Bitcoin mining over all those other ones. And it is an individual choice that I make as a consumer. This is a big question, actually. It's a question of how do we structure our society? Do we choose as individual consumers, or do we elect some overlord to lord over us and tell us what we can and cannot do?
No, but hang on. It goes beyond that, because this has been debated, discussed. There's a massive misconception, and it goes back to taking the red pill and going down the rabbit hole and doing your research. Everybody here, depending on your level and how much you've been involved in that space. Money is printed, is moved, there's banking, there's all sorts of people moving stuff around. This is just mining, and that's it. The rest is just phones, moving bitcoins left to right.
There is hydropower.
If I comment it, there is one very serious force working in this area, and it is miners really need to get as cheap electricity as possible. For example, in Middle Europe, as cheap electricity as possible, which leads to a current state where you don't find miners in normally populated areas anymore, because the electricity price is too high.
What if electricity was free everywhere? What if we...
There is a lot of theoretical questions like this, and I don't have all the answers, but...
The electricity is cheaper, there are more miners, more food to China.
But only in limited areas where there is not a different buyer for the electricity. Because people tend to spend much more money for electricity for Christmas tree than miners pay for electricity for mining. So it pushes them to places where there are no people, there are natural resources, typically super cheap to use for mining. So things like power generated from some oil rig, gases, because there is no usage for it anymore, but you can use it for harvesting energy and mining. Some hydropower in areas where it is too costly to transfer the electricity from that area toward populated areas. You will find a lot of miners concentrated there.
On an oil rig.
Yeah, so there is not a strong competition between like regular usage of electricity and miners, because miners tend to find the places where there is no other usage for electricity. So yeah.
Let me touch on this for a little bit. So miners will spend as much money on electricity as the block reward allows them to. That is a grounding principle of mining, is that it is the costliest chain that is the true chain, right? That is the consensus rule. The true chain is the chain with the most accumulated work. So it is the chain that has the most provable amount of energy put into it. If we were to find some way to produce, we cannot produce electricity for free, that is nonsensical, but we could produce it for, call it, very, very cheap. What would happen then is that miners would still spend the same amount of money that the block that the block rewards them every time, and they would just spend an absurdly higher amount of electricity on it. Is how that would play out.
At the moment, how much it costs to make for production of 1 Bitcoin from the mining? If you look at the hash rates now.
There is a clear upper bound, and it is Bitcoin price.
Yes.
It's upper bound. Just
If you would spend more money for making Bitcoin than buying Bitcoin, you would not do that. There is only one reason why you would mine under these circumstances. It is long-term electricity contracts with your utility provider. This is the only reason why you would mine with...
Block rewards goes to the accepted block, right? So that's not going to be distributed to everyone, right there. So you still have a lot of...
Then the pool mining is kicking in.
Yeah,
So it
now,
always...
it's going to cost around $17,000 for every Bitcoin, which is obviously more than that, what is now.
sorry.
So if you look at the hash rates,
Yeah.
and then you divide it, and then the production of a Bitcoin for the whole mining things which is happening all around the world, it's going to cost about $17,000.
$17,000?
Yeah, 1%. Yeah, $17,000.
Yeah, I need to push back on that.
I don't believe that.
You can just go and check
I mean,
it out.
you can check. Okay, we can have that discussion
Check the
later.
hash rates
But
and do right.
I would like to see our clients mining for
Related to the Bitcoin.
why would
price,
anyone mine if it costs them $17,000 per coin?
if you take the whole hash rates available there,
Yeah?
yeah, and then you divide it, and then you...
Yeah, but you're
Electricity as well.
Variable, yeah.
you're doing assumptions about the electricity price, and it's not easy.
If you're in the middle of New York City, maybe, you're paying 20 cents a kilowatt
We can talk about this later. I think you might be missing a couple assumptions in the way you model this. It's a complicated matter.
Yeah.
Yeah.
So is it higher or lower than he says?
Much.
Like Pavel said, no one's going to mine at a higher cost than the Bitcoin price. That doesn't make sense. So the upper bound for mining is the price of Bitcoin, and the price will draw the hash rate with it. And we've seen this happening in both ways. So when the price goes up, the hash rate will increase because margins increase on mining, and they want to add more hash power to their operation. So they add more hash power. Difficulty increases to keep the block frequency at the prescribed frequency, and then the cost goes up. If Bitcoin price falls, the highest cost miners are booted off the network. Hash rate falls, difficulty drops again, and then the mining cost resets downwards. In this sense, it's like a little bit like commodities, but not really, because no matter what the price of Bitcoin is, the cost of production will creep up towards it, minus the smallest possible competitive margin that the overall mining industry will tolerate.
So what margin of profit are you looking for?
I mean,
For each of those situations?
It's not a normal business industry. The clear thing that if you look at how the Bitcoin price move itself, it's ridiculous. So you can target to whatever point you would like, but the reality would be different. So what we calculated last time we did the maths was a good electricity price can bring you like 25%, 30% margin, which is something what is quite nice, but it's super risky industry. So if there are bigger movements and a lot of, for example, competitors bring new machines in, it could kill your case. Again, there is like price spikes, which makes your life much nicer. So yeah, it would be difficult to target one number.
so I mean, this is the way it's similar to commodities production is that it sits along a cost curve. So some producers have access to really cheap electricity, at least up to a certain amount, and then there is a little bit more expensive electricity up to a certain amount, and there you move your way up all the way until you hit the marginal producer who is mining right at the margin, and they're the most precarious ones, right? So you have people that are making solid margins near the bottom of the cost curve, and then you have people who are making very slim margins at the top. So it's not like all miners are mining at the same cost. Your electricity production is probably your biggest factor cost, and then the second thing is how smart or how well connected were you when you got your hardware? Did you pay a lot? Did you pay a little? You know, did you get a good deal on your capital investment or no? And all of these things play into miners' individual margins. So this is why we say when Bitcoin price drops, you have the highest cost miners booted out, and the lowest cost miners are still there. And there's no real, you know, you can't put a number on it. So. And also, this is why we need hash rate derivatives, and this is coming, so that miners can offload their risks and sell their hash rate to either speculators or whoever wants to take the other side of that bet.
Can we have one more question, because everyone can smell pizza, and we will be able to carry on the conversation.
We'll do it by the pool table.
I mean, what do you want? Do people want more questions? Well, pizza's getting cold. There's always a trade-off.
Yeah, you can eat.
We gotta eat.
Do you, the audience, do you want to listen more and ask more questions? You can just get cold. Is that cool? Yeah. Go on then, Charlie.
I'm going to grab a bit of picture and listen. I'm multitasking.
My quick question is,
yeah.
Let's just pretend hypothetically, you know, I'm a Bitcoin speculator and what I care about is the price. Why, given that the supply curve is completely deterministic and predetermined, it has nothing to do with the total amount of hash power, right? Why should your average Bitcoin trader care about what the cost is on Bitcoin? I get normal commodities like, you know, if the cost is high, you know, there's less oil production or whatever. But in Bitcoin, the supply curve is completely inelastic to the cost. Why does it matter?
Well, it drives miner behavior. So
it's just how fast the miners are liquidating, basically.
Well, I mean, yes, there's that, and increases and decreases in hash rate does have an impact on the production rate, at least up until the next halving. So there's that to look for too. But yes, it's not incredibly interesting to like ye old, you know, Bitcoin speculator, but knowing when miners are near their cost or when they're wildly in profit will tell you a little bit about when they're likely to sell a lot of their production versus when they're likely to not sell a lot of their production. So this is, you know, I would expect mining to turn more and more into traditional commodities business models going forward, where you know we have proper hedging products, and this becomes less and less of an issue. So you know, there's something that we can hopefully look forward to. But as it is today, a lot of miners do actually take risks with their balance sheet. So it is actually important to monitor this to try and figure out how they're going to behave.
If you're using a sort of commodity analogy, there is no Saudi Arabia. So, for example, oil.
Right.
Saudi are always manipulating, controlling supply and demand of supply. It's not possible in Bitcoin, right?
Not really, not unless you have some sort of extremely cheap electricity source that allows you to mine a lot cheaper than everybody else and therefore get a lot of the coins, but I don't think that exists.
There is one thing which is...
Yeah, and where is Fredcat?
Still working on submersive cooling. That's all I heard. 2 weeks away.
But related to the extremely low price of electricity, it tends to be on places where there is not a lot of that energy. So you can cherry pick places with very, very nice price, but you cannot scale the operation typically. So you need to distribute it, which brings you to another costs related to this, and there is only a limited amount. So it averages pretty much nicely. The power law is working nicely.
And then you've got, I mean, what becomes the commodity is we'll come back to the debate about block size, because that is the commodity, that limited space. Because obviously everyone's thinking about the inflation, and we have block rewards, which are there to seed the network and motivate miners to support them. Have supported the network, but eventually it will just be fees paying for the network, and it will be, the commodity will be the size of the blocks, and then we'll come back to that debate.
Yeah, maybe one more. Yeah, one more remark. General public like general Bitcoin public should be interested in Bitcoin mining because of the risk part of the whole equation. You want Bitcoin mining to be healthy so that you don't have to think about it.
What can a general Bitcoin user do though?
Pay good fees.
Yeah, there can be a lot of public visibility given to the mining. You can watch, you can ask, you can be like active in the space at least to some level. But yeah, only a limited set of things what you can do.
How common is edging for miners, and what's the most common way of edging?
We know about few financial products for miners where there is a counterparty capable of doing taking other part of like selling the coins for particular price, so you can limit your risk as a miner, and the counterparty can make money if the trade is going in the right direction. And we know about things like that. It's not institutionalized yet. There is not a like really liquid market with derivatives on. It is not yet common, but there is at least 3-4 different teams working on something like that right now.
So, you know, you can sell your coins forward, but you still have risk then, because you ultimately don't know how many coins your hash rate, you know how much hash rate you're going to be able to deliver more or less, but you don't necessarily know how many coins that's going to equate to because you're exposing as difficulty. So what we would need is a deliverable hash rate future, for example, where somebody, a speculator or whoever, would take the other side of that trade and buy that hash rate and whatever coins that would deliver speculatively, so that the miner could offload their risk. And there, like Pavel said, there are many teams that are working on this right now. There's not like a big liquid market for it yet, at least. So.
Right, let's just have one more question. Dan, you've had a couple. Do you mind if I... Oh, sorry, no. We have 2 more questions. We'll come on to you last one.
All right.
Sorry.
I'm Nuno from Kudos. So we actually are a mining software company. So what we're doing actually is 2 things. One, we're building partnerships with service providers, data centers that already have cost of electricity, and they have huge excess of it, and huge excess of compute power. So what we do is actually turning those service providers into miners. So rather than costing them money to run that spare capacity and that waste of electricity they already paid for and are contracted for, then we use to mine. So it takes a lot of education, that's one. Number 2, like you said, for the big commercial mining farms, if it's not returning them a profit, then it's a big issue. So what we do is we build a profitability engine that receives various types of different workloads. Mining is one of them, but then receives video rendering, AI, etc., etc. So for you as a commercial miner, as long as you have the right type of hardware, when it's not profitable to mine Bitcoin, then we will use that for video rendering, AI. So that means actually you splitting your...
So this is with GPUs, it sounds like.
GPUs and CPUs. ASICs obviously is meant for one thing only.
There is somebody in the world mining Bitcoin with GPUs today?
It's very surprising to me.
It needs to have a good
Wow. I have learned something today.
Is this because the costs are already sunk? So it's cost recovery. You're not actually like profiting from it, but you're limiting your loss.
For the service providers, yes.
Yeah. Okay.
And what we do is as well, it's about be more environmental friendly, because building data centers, we're talking about cost of electricity for mining farms, but we're forgetting that building data centers and coping with the demand of computing power actually consumes more electricity than the mining farms.
Yeah.
And when you look at most of the mining farms, they're actually eco-friendly. They're using natural resources as well. So what we do is exactly that. It's that wastage.
Is awesome edge case. It really shows that there can be places with zero cost electricity, but obviously there is a limited amount of this electricity because the data center tries to run different kind of workload for better utilization of the electricity. But there can be some spare electricity for basically zero zero price, and then you can mine. And mining, it points exactly that there are places you can cherry pick and mine, and these will be the last standing because the electricity can be almost zero. It is really interesting use case.
We just have one last question then, because you could carry on mic. We will do.
Pablo, you spoke a lot about the risk, concern about the risk and how this niche business is so core to Bitcoin. So speaking about the risk, like what keeps you up at night as we approach the halving, and related to the same question, China is still a big part in this business, and in everyone's mind, the big risk right now is coronavirus. And in your view, are miners ready for the halving with this risk in mind? Have the producers of the hardware delivered enough of the new ASICs before the Chinese New Year? Is this going to impact the production, or is this something not worried about? Is the professionalization or institutionalization of miners led to people being prepared much ahead of time?
Yeah, few things. We can see difficulties of delivering new hardware, but I don't think it impacts the Bitcoin network anyhow. It just slows down the new hardware running the network. Towards halving, what I'm afraid of personally the most is if smaller miners would make it, because it's either my personal as a person loving Bitcoin, and at the same time we have a responsibility for a company, and we have mostly smaller miners historically, and I would really like to see small miners being still present after halving, but it is mostly given by the price. So I hope for the price depreciation because of small miners mostly. We can cut our costs for by various measures, but we will never replace small miners if they stop to mine. And we can see that there is less and less miners in the space, which is not a nice thing to see. So this is my biggest wish for halving.
Thank you.
Yeah, this is just, it's an economic reality of the larger your operations, the lower your cost. This is how it is. So it's a losing battle over time in terms of small miners are fighting an uphill battle here. But if you're worrying about this ending up with just centralization in a few hands, you gotta keep in mind that the floor or the limit on that is that you cannot have any more centralization than the power production, right? So you cannot have mining centralized in one entity unless all the power in the world is produced like right there. So we do have some breaks there that will sort of stop this from becoming just one big operation. And there's competition, right? There's tight competition.
But there is one thing people don't tend to see very often, and it is you can geographically distribute mining, but it doesn't solve the problem. Because what we can see is Chinese miners expanding into the West. There is a lot of mining farms being built right now in the US, owned by Chinese miners.
And opposite.
And the opposite is true as well, but there is a more difficult battle to win if you are a US miner building a mining operation in China than the other way around. So it is not really clear how distributed the mining actually is, because it doesn't matter if it's 20,000 places if there is one controlling person. So, and this is quite difficult to monitor.
Is it conceivable that there be two monolith mining companies that will end up fighting each other? Is it conceivable?
Yeah, you don't want this, because but it can happen.
You can conceive of a single one, right, being just so much better at mining than everybody else in every way that they take over.
We should find some positive ending. This is too sad.
The positive ending is that this is not what we're seeing. You know, even within the hardware space, we're seeing competition. We're seeing multiple people like vying for the same spot. Yeah. Well, this is the strength of capitalism: is that you have free competition. There's always someone who has a better new idea who comes in and disrupts the space. Like,
thanks for listening.
Last question. We mustn't make price predictions, but we've got 2 data points we've had. This is the third halving. Third halving, a year later, there was a bubble. Second halving, a year and a half later, there was a bubble. Because we've got 2 data points. What's it mean? What's your thoughts?
Oh my God, another rabbit hole, right? Do I believe that Bitcoin markets are efficient? No.
Something positive.
Yeah. No, but I mean, it just means that I don't think that there is a way that this could be priced in. So I think it's priced in to a certain degree, but it's back to do you even believe in any of this? Like, think about all the people who've never even heard of the halving, or who haven't even heard of Bitcoin, and that might be coming in from the space. Think about all the people that have constant buy orders set up to dollar cost average into Bitcoin at a steady rate every week. When you have supply cut in half overnight, I mean, even if speculatively the price is bid up before that, over time, that would start playing in. So in my opinion, we should see an increased upwards pressure on the price. Do I think it's going to manifest overnight? Of course not. Like, these things take time, and that has never happened before, that the price just spiked overnight, even though the stock-to-flow model would suggest that it would. So I think there will be a positive net upwards pressure on the price, but that could take a long time to manifest.
Quickly, we think that most of the coins are put on the market from miners right now, at least slightly over 50%, or not far from that. So it's going to change the market balance a bit, at least. So $16,400 at halving.